function is open. We have, of course, offline chats. If you want to tell us a little bit more about yourselves, please feel free to put it in the chat function. We also have the emojis are open, the reactions. So if you like what we're saying, please give us a clap, give us a heart, or whatever you feel like giving us. Thank you for the heart. And the Q&A, if you've got some questions for us, if you would got a question for Prof King that you would like to ask, please put it in the Q&A so I can get to it easily. So I see we've got people from the USA, from Johannesburg, from Zimbabwe. Thank you so much for joining us today. I think it's going to be another very good discussion. This is the third in our series of Taking the Helm with Professor King. And we're really looking at the chairing boards of organizations. And today we're looking at chairing a board of a holding company, or the board of a company or an organization that is responsible for a group of organizations, however that might be constituted. And let me hand over to Professor King with the first question. Is it any different, first of all, chairing a board versus a holding company board? And then what do you think is the biggest challenge that you've experienced in chairing that kind of organization?
Thank you, Karen. It's the holding company's problem rather than my personal problem as the chair. And the holding company would have had a very successful run, let's say, for 5 years in the production of its product. So I'm going to call it Rosie's face cream. And it absolutely swamps the market in South Africa and outsells Chanel and well-known face creams in South Africa. So the board decides we must try and make this really a global product. And so that's an organizational goal of the company. And we say we will start by forming a wholly owned subsidiary in Australia and another one in England. So from a governance point of view, we would like the subsidiary company to be governed on the same principles as we govern, namely on an outcomes basis, and to achieve the 4 goals that we set out in King 4, which is value creation in a sustainable manner, adequate and effective controls, legitimacy of operations, and trust and confidence by the community in which you operate in the company itself. And so you can write that into the MOI, or the Articles of Association, as they will be known in Australia, so that the company actually has that in its Articles of Association, and the board of the subsidiary and the directors of that subsidiary owe the duty to that company and not to the holding company. But they're bound by what is set out in the Articles of Association, or Memorandum of Incorporation, as we know it here in South Africa. And then usually one finds that the standards of marketing and advertising are not the same as the standards in our country. And I know, having chaired companies which are group companies, and having been the chairman for many years of the Advertising Standards Authority in South Africa, that the standards of advertising here and Australia and England are not the same. On the question of hyperbole, for example, making claims that your product can do X, you've got to substantiate that. Otherwise, a competitor complains about it, you'll be ordered by the Advertising Standards Authority to remove your marketing and advertising campaign. So one of the important things is that you would have established this reputation in your Rosie's face cream. And of course, you don't want to dent that reputation at all. So you write that into the constitutional papers of the subsidiary company. And the board then has to act in the best interest of that company, but is subject to what's in the constitution. So then strategy. You've got a strategy to promote your product, and maybe even your strategy you can write into the Articles of Association. This is how we go about it, and we want the subsidiary to do it the same way. So you can write that into your Articles of Association of the subsidiary. Then 9 times out of 10, it's the holding company that gives the subsidiary the working capital to start the Rosie's face cream in Australia. And that's a contract of loan. So there you can put terms and conditions in, which obviously have to comply with the law, corporate law of Australia and our subsidiary in London. Now, the law of contract in England is different from our law of contract. Of course, it's on a quid pro quo basis. And our law of contract is not the same. It doesn't have to be mutually beneficial. And Australia follows our method, but England has got a quid pro quo basis for its law of contract. So you have to be very careful in setting that out in your Articles of Association. So what is the bottom line there? The bottom line is you've got to look at what is the legal position in the foreign countries where you're establishing your subsidiary, and make sure that the Articles of Association or MOI that you're drawing for the subsidiary is consistent with their legal requirements. So that's number one. Then there's the question of remuneration. You need to set out a corporate remuneration policy. That can be done contractually, and usually in a foreign country, you will find there are regulations about remuneration. And so you have to be very careful. So rather you do it by way of a contract with the subsidiary, so you've got more room to move, than in a constitution. And then, of course, you want dividends from hopefully your successful company in Australia and New Zealand. So you set out a dividend policy which can be written into the Articles of Association, that if you've got profit after tax of X percentage in relation to your balance sheet value or whatever the ratio is, you will declare that as a dividend to the holdco. But that's got to be in the Constitution. Again, you've got to look to see if that's consistent with the legal requirements in Australia and England. Then there's the question of reporting, Karen. The subsidiary has to report to us. And with the coming age of sustainability reporting, it's going to be a huge problem with group companies. Because, as you know, you being an expert on sustainability reporting, that there are 3 main standard setters internationally. That's the GRI, the ISSB, and the CSRD of the EU. There are, of course, a localized one like India, etc., but those are the 3 main ones internationally. Now, we as directors of the holdco want Rosie's face cream to be international, and so we want the reporting to be international, and we've got to consolidate that into the holding company. So in South Africa, we haven't yet been mandated what international standard of sustainability reporting we're going to follow, nor have they in Australia, nor have they in England. But during the next, I say, 2 years, I think every country will be mandated to follow. And we, being the holdco, would follow an international standard, because now we're going global. And it's just not something created locally in South Africa, of which there is not anything, but we wouldn't do that. Then we must agree to put into the Articles of Association the definition of materiality. What is material? That they must report up to us, and they must undertake that their reporting will be, the materiality will be tested according to what's defined in their constitution, in their Articles of Association. Then, in the Articles of Association, very important to have dispute resolution, because inevitably things just don't run smoothly. You've got directors there that, let's say, we appoint a very experienced board in Australia and in England, and they know they've got a duty to that company, but they've got to report on a certain basis, which is in their articles. But the disputes will arise, Carrie, and they usually do in group companies, and you must have a mechanism to resolve that, and that's really by arbitration. And being a South African holding company, we would put in that it must be done in terms of the Arbitration Foundation of Southern Africa, in terms of those regulations. Now, London has got a superb international arbitration centre, but we say it must be held in South Africa where the HOLCO is, So you will see there's many important things that you have to take account of in drafting the Articles of Association of the subsidiary. And some people get confused between the subsidiary following the determinants in the Articles of Association from the contractual link between the HOLCO and the subsidiary, where you could have other terms different from what's even in your articles if we want to. So one's got to be careful that you're looking at a contract or you're looking at what's written down constitutionally. So there are many aspects that the board of a HOLCO has to take into consideration. And I've just touched on each one, and each one, of course, needs an application of mind and agreement to promote now the purpose of the HOLCO, which is to make Rosie's cream a global product.
Thank you. So what is the difference between the MOI and articles that you mentioned and the shareholders agreement? If you've got multiple shareholders in the Australian entity, how's that different?
If you've got multiple shareholders, then of course you need the shareholders to agree to the terms of in the Articles of Association. So you need a general meeting of shareholders to agree to that. And you've then got that agreement. A contract is between the two companies, and that's the board is looking at those contracts and not the shareholders. The board looks at those contracts and determines those decisions.
Interesting. And in South Africa, in the King codes, your namesake, there's a reference around groups of organizations where the holding company, or essentially the majority shareholder, is responsible or should provide a group governance framework for the group. And that governance framework sometimes becomes a management level framework as well in terms of policies. Can you just give us a little bit of guidance? Because you mentioned that the governance of an organization, this Australian subsidiary, actually lives with the directors in Australia. How does the governance framework at a holding company is expected to work when the company is sitting in Australia and those boards?
So there again, Karen, you and I would have to look at Australia. I don't know, but Australia could have mandated, in other words, could have made a legal requirement, a code of governance, which could be different from the 4 outcomes approach of the King Code. So you can't put into the Constitution that you must govern in terms of the 4 outcomes based, it would be contrary to their legal requirement of the company. So you've got to adjust what you want in your governance framework. So you can't just stamp, as I used that word before, stamp onto the subsidiary what you want. You've got to look at what the law is in Australia, and you've got to be guided by usually your appointment is with Australian directors, people who are Australian citizens and experienced directors in Australia and know the legal requirements in Australia. And I don't know what the advertising standards requirements and the marketing requirements are in Australia, but they're probably very similar to ours, because ours is based on the UK standards of marketing and advertising, and I should imagine Australia has followed the same. So, but again, in putting the marketing that you want of Rosie's face cream in Australia, you've got to make sure it's not inconsistent with their requirements of marketing and advertising, of which they've got a code in Australia. So yes, framework, but you've got to take account of what the legal position is in Australia and in England before you, as the Helco say, this is how we want it done. I mean, you can't expect your directors to go against the legal requirements of the company. And the company would, our company, Rosie's Face Cream, would be contrary to the law, and that's not in the best interest of our subsidiary or the reputation of Rosie's Face Cream.
So it seems to me that there's kind of four instruments that you've been speaking about. It's the MOI, or the Articles of Association. It's the Shareholders Agreement. It's the Governance Framework. And then there are also other contractual arrangements. So there's four kind of instruments. Of those, which ones are, I mean, I'm looking at the governance instrument, the governance framework, as being a step beyond compliance, is that this is how we want you to behave, as opposed to the compliance requirements. Is that where you would put something like your code of conduct or reputational issues? Would that sit in your governance framework?
It would be in the Articles of Association of the
as well,
subsidiary, because that's critical, that you want to create how we do things around here when no one's watching us in Australia, the same as we do it here in South Africa. So you want that culture that we've established here in South Africa to be there, and we want our directors to realize that they're guardians of the company's assets and business affairs, and that they are the heart and conscience of the company. We want them to accept that from a leadership point of view. So we could write that kind of issue into the governance framework, and provide it's not inconsistent with any, because let's assume for a moment, and I don't know if it is, but let's assume in a moment that they've actually legislated about their code of conduct of directors in Australia. And they've actually got legislation similar to our Public Finance Management Act, for example. Well, obviously, then the company in Australia has to comply with that law. And we can't put in the constitution of that subsidiary company things which are inconsistent with the legal requirements of the subsidiary in Australia.
And what about something that's a bit more, the fine line between governance and management is the strategy. So I often hear about group organizations wanting to apply a group strategy, but actually the subsidiary, isn't that the responsibility of the board of that organization?
The answer is yes, but in promoting a product which you want to go global, it's very important that the marketing and advertising is the same everywhere. Because as soon as you market differently or you advertise differently, you're going to start touching on the reputation and the image of
the brand promise.
Is facing the brand value, absolutely. So that's an important issue which should be in the constitutional documents of the subsidiary. In other words, the Articles of Association or Memorandum of Incorporation. And so the board has got to work around that. To me, that is the most important issue when it comes to holding and subsidiaries. And it becomes quite complicated when the subsidiary is, let's say, two shareholders, let's say 50% shareholders each. And now you've got to hold a share, you've got to have a meeting where you get agreement from yourself as a shareholder, and let's say the holdco has got 51% and 49% is split 10 times. Well, then you've got to call a general meeting of shareholders and agree to what's in the Constitution, and put it in the Constitution that they will market and advertise according to as directed in the strategy. Management will follow the strategy of management in the holdco.
So what, in working with groups of organizations, I find the articles or the MOIs they've been gathering dust for decades, and they were registered and lodged and never to be seen the light of day again. But from what you're saying, that's such a critical document for the governance of an organization.
You're absolutely
correct,
group. Cheryl, and let me go back to my days practicing as a senior barrister, that many cases, in the corporate legal cases, I won, or as a result was settled, because of something in their articles of association which just prohibited them from doing something. And they had their locus standi, their right of going to court on this issue, just had disappeared, because what was written in their articles, and you're absolutely right, that a lot of people, including the legal advisors of the company, sometimes don't look at the articles of association. So in architectural terms, it's the foundation of the company, and the strategy of how you're going to manufacture, and that whole strategy, it's contractual. But the foundation of the company is the governance framework, and you've set it out in your constitution.
I'm going to ask some of the questions because they're about what we've been speaking about before I go on to something else. So there's one from Paul here. In the example given, where the board of a foreign company is reporting to the board of the ultimate holding company, is there a place for monitoring and evaluating the performance of the subsidiary board? If there is, how would it differ from monitoring and evaluating the performance of the subsidiary employees? Do you have a place as a holding company to monitor the governance of the subsidiary board?
The answer is it depends on what you put in, again, in the Articles of Association, because you can write in there that you want them to have the 4 outcomes-based approach to governance, assuming that's acceptable in terms of Australian and British law, and that the holdco has the right to have oversight over the company to make sure that that it can be seen that they're achieving value in a sustainable manner, etc., etc. So you can write that in to have. So there's Anna Marie saying it's a critical document, especially considering that in South Africa, well, not in South Africa, but their provisions different. As I point out, the law of contract is different in the UK from our law of contract. So you've got to take these things into account. So the short answer to Paul in that question is yes, you can, but is it in the articles?
Yeah.
If it's not in the articles, you've got no right to, because the board of that company has the duty of oversight, etc.
Yes, to go through past the board into the employee level.
Correct.
Absolutely. So that autonomy should be protected, and it's protected in law. And if you haven't broken through that autonomy by agreement in the articles, then you have to stand by the letter of the law, right?
Absolutely.
Yeah. One from Kerry. And Kerry Bass actually was part of a webinar earlier this week on Tuesday. Kerry's based in the US. How does the chair of a holding company, the holding company group, normalize non-financial outcomes to meet the expectations of global set of stakeholders, i.e. social benefits to communities globally? Again, different jurisdictions have different requirements. Is that something that you can do at a group level?
Well, again, if I think Terry's talking about ESG issues. So there might be different requirements about ESG issues in Australia and England compared with the whole co in South Africa. So, and if they could be legislated. So you can't put into your article something which is inconsistent with the requirements for that in Australia and England. So again, you've got to talk to your directors who are Australians and English directors of experience who are going onto your subsidiary board, and find out what the position is. And of course, you've got to have international legal advice as well to make sure your articles are written correctly. So I saw Anna Marie was on the line asking a question. Now, there's an experienced company secretary. So she would know, Anna Marie, being a company secretary of a holding company organization and with all subsidiaries, how difficult it is to put the pack together for the holding company board. Because financially, one understands the question of getting the financial information up and then putting it together in the holding company. But when it comes to sustainability reporting, Kerry, it's going to be very interesting. Because let's assume we follow the ISSB standards if and when Section 203 of our Companies Act is amended and there's a corporate standard council to pick an international standard of sustainability reporting. And let's assume we go with the ISSB, but Australia has gone with the CSRD and London's gone with the GRI. I mean, it could be.
Apples and pears.
Apples and pears. So you've got to be very careful of what you agree contractually, and of course, very difficult, very careful what you write into your foundational documents, into the Articles of Association.
And then you've also got the issue of when you're sharing information like that, and not only sustainability, but also financial information, and you are sitting in different jurisdictions and your companies are regulated, highly regulated, especially in financial services, those regulators don't want you sharing a whole lot of information across borders with other countries. So there's that as well we have to be careful of. Now, the holding company must take that into consideration, surely.
That's why I say at the beginning, I said one of the considerations in drawing the Articles of Association or subsidiary is the question of materiality.
Yeah.
What is material and what would be material for you to report up to the holdco? And if there are different laws in Australia to South Africa, how do you do it to meet that inconsistency in reporting up? And to eventually consolidate all that information up in the holding company. So
sounds to me like a lot of groups have got a lot of work to do.
So, Kerry, as you know, there is compliance panic at the moment. Large companies, let's say all listed on the Johannesburg Stock Exchange, I'm going to assume have the wherewithal to consult with an informed advisor about the standard of sustainability reporting. But if you don't have that, if you're a second-tier company, let's assume you're Rosie's Face Cream, you started in Clarksdorp, and you had the local accountant drawing your accounts and doing your tax returns for those, and suddenly there's a mandatory reporting of sustainability, and now you start with a subsidiary company. I mean, you're going to be a little bit lost, and you're going to have to get advice and help. And that's where the initiative started by the GGA, the ESG Exchange, the Sustainability Exchange. With our playbooks, I think, if I may say so, I think it was a genius move to help second-tier and other companies around the world and organizations, forget about just companies, organizations, because as the world, as the planet Earth degrades more and people become more anxious about sustainability of the planet, you're going to have a greater focus on sustainability issues. So it's already 80-20 from a value point of view, 20% financial, 80% non-financial. So there'll be more anxiety about those things, but less informed people who are actually directing the company. So it will need people like you and me, Kerry, to actually advise those companies and help them. Because they won't know their Arthur from their Martha. I mean, with respect, first of all, they won't know how to source the information. And then, digitally speaking, where are the data points? So it's there's a bit of compliance panic going out over there, outside. And the quicker that we know what our regulator, which international standard they believe is in the best long-term interest of the health of South Africa, the quicker our companies can move, especially if it is a holding company with subsidiaries, or if it's planning to have subsidiaries. Because then we've got to know, let's assume we're following the ISSB standards and Australia is following the double materiality standards of the CSRD. Well, then on a reporting basis, we're going to have a few issues and we've got to sort it out.
So the holding company board needs to understand all of these standards that the subsidiary companies are having to operate in terms of their requirements.
Let's assume that the holdco has a regulation now that says we must follow the CSRD standards, the double materiality, inside out and outside influence on the three pillars for sustainable development, the economy, society, and the environment. And let's assume Australia is ISSB, so they focus on the risks and opportunities of financial outcomes. And interoperability, well, I always understood that if you had something which is material and it just impacts as an outcome, let's say a global outcome for the world on the degradation of the planet. And it's not really financial, that will become financial, that you could use a standard of the GRI. But as I understand what the ISSB is saying now is, no. You must keep following the ISSB standards and guidance. And I think the ISSB are going to about to come out the same as SASB did, Sustainability Accountancy Standards Board of America, which, as you know, IFRS involved. With about 100 different industries, specific ISSB standards for. So the SASB had 77 industries, special sustainability reporting standards for 77 different industries. But I think the ISSB is going to come out for consultation with, as an exposure draft, with over 100 separate industries. And so
you've got a diversified holding company.
Yeah, that's correct. No, you've got a diversified holding company, let's say, in 30 different jurisdictions. Well, so you have to be careful how you're going to consolidate all that up at the top.
Yes, and that leaves. Sorry.
So Anna Marie's just pointed out correctly that the holding company would be appointing the directors as the majority shareholder in the subsidiary, would be appointing the directors in the subsidiary. That's correct. But still, you have to be very careful in drafting your articles of association in your subsidiary to make sure it's compliance with their regulations, with their laws, and yet you're getting the information up what you need for consolidation up into your holdco.
And just because you appointed those directors doesn't mean that those directors owe a duty to the holding company for appointing. They owe the duty to the company.
To the company, correct.
Yeah.
And
so
that's why you have to saddle or diminish that ability to just act in the best interest of that subsidiary. You diminish that duty by writing into the Constitution that they have to, from a marketing and advertising point of view, follow the group strategy in order to get Rosie's face cream known better around the 30 different countries that you're operating in. It
Now,
gives you a global product.
what happens if that group strategy is no longer working for the subsidiary? If it's to the detriment of the subsidiary, what does the board do? Subsidiary board.
That means that your product is really not successful in Australia. And even though, so you, in terms of the Article of Association, the board, they can't change the strategy and the marketing and the advertising. They've got to follow what the Holdco is doing, and it sort of makes sense that you keep that reputation of Rosie's face cream going, the brand. And but if they want to go elsewhere, or maybe through regulation they have to do something else, well, then the Holdco, we've got to put our thinking caps on how we try and protect our brand in Australia to make sure it's got the same value to people as Rosie's face cream has in South Africa.
And we have that problem with sustainability, is that, you know, what happens is, just take South Africa, what happens in Namibia next door, being, you know, a greenhouse gas sink to South Africa, which is the largest greenhouse gas single facility emitter in Africa, and in fact in the world. We've got very different sustainability priorities. And go to Patrick Kabuya. Well, welcome, Patrick. Lovely to have you online. Patrick's asking now from a geopolitical question. So we're getting definite geopolitical differences happening across different countries. So as a chair of a conglomerate, can you share practical tips of how you would steer the direction and the strategy of the organization to effectively deal with the multiple global crises facing us today? And just bringing it in the context of those global crises. There's global, but there's also local, national crises. So how would you advise your board to go about the organization to deal with that?
Well, it's very interesting, Kerry. I've been consulted by a different country from South Africa about certain developments they want in their country. And because of geopolitical issues, I would advise them that they should persuade the boards of the companies in that country to have as an agenda item, constant agenda item, geopolitical issues, because of the impact of the geopolitical issues in that country on their supply chain, Mr. Trump's tariffs, on the flow of naval traffic, the Houthis sinking cargo ships in the Red Sea, changing their routes, the cost of in the supply chain of getting your materials to your company to make Rosie's face cream. So geopolitical issues have suddenly become a huge issue in making business judgment calls. So you've got to be alive to the geopolitical issues which are impacting on your country. So in South Africa, we've got huge geopolitical issues. I mean, Mr. Trump is not happy with South Africa being out of BRICS. He's not happy with South Africa going to the International Court of Justice. He's not happy with several things Mr. Trump is not happy about. So I don't think, I think our government, and certainly our Minister of Agriculture, is quite confident in the pause period till the beginning of August that he can negotiate something better with Mr. Trump. But I think there's going to be difficulties. So you can see that issue alone, the board needs to focus on it now in South Africa and see what's happening in its subsidiaries. So geopolitical issues, it's become, to me, a new fascinating aspect of corporate governance, is becoming a critical agenda item on boards, that especially in regard to your supply chain.
So how do you get that information going from a subsidiary board in terms of their perspective of the geopolitical issues that are facing their company? How do you get that information up to the holding company board? Is it a reporting? Is it
that you would have written in your guidelines for reporting, and you would say anything which is material, which you would have defined. And clearly, if there's something geopolitical which is impacting on that company adversely, they would be obliged to report it through your definition of what's material. And they would have to report it. And then they would propose a strategy to meet that issue. And Holdco would see if it falls within the definitions in the Articles of Association. If so, they can stick their nose in and say, no, no, do this, do that. And if it doesn't, well, then the directors have to act in Australia what they think is in the best long-term interest of that company in promoting Rosie's face cream.
So it's so important from what you're saying that the directors that the shareholder is appointing are not just executives of the shareholder. I see that all the time. And now you've got executives that can't direct, they're executives, and they are essentially trying to manage the subsidiary, but the subsidiary's got complexity.
You have to have what I call them is local directors. You've got to have people who have lived and absorbed the Australian culture and the way of life and everything. And you can't just plonk an employee from the South African company to fly across for a board meeting or
South Africans arrive.
On a Teams meeting, have your board meeting, and you actually don't know, the whole culture and how they do things in Australia. So you need that local input. It's very critical in subsidiaries when you're in foreign jurisdictions. So that's something that you have to do. And I've happened to have chaired companies that have subsidiaries in foreign jurisdictions, and you've got to be alive to what's happening in those foreign jurisdictions. And you get that the difficulty happens when you have we have the unitary board system here, as you know, but in Europe, for example, you've got the double board system. You've got the supervisory board and you've got the executive board. So your non-executive directors sit on top. And they don't eyeball the chief executive who chairs the executive committee. And I think this was the biggest problem in Steinhoff, because you had this charismatic leader in the executive team who influenced some of the non-executive directors just through his charisma and his character. And with the consequences. And I mean, some of the things they did in the company was he took liabilities and put them into foreign companies' names and just took them off the balance sheet. Or they overvalued properties and had someone give a certificate, this was the valuation. And so it would be consolidated up to the top. And Steinhoff was believed to be valued at X. In fact, it was X minus Z. And when that came to that crunch board meeting, when the auditors, Deloitte were the top auditors of the holding company, said, no, we want this information, that information. He said, oh, I'll supply it. Well, he kept on saying he'd supply it, and he never did. And as you know, the consequences. So absolutely, you've got to be aware of all these changes. And so it's been fascinating for me advising this country at the moment about their situation, and their situation is critical. That they need to get all their boards in the country to actually have geopolitical issues as an agenda item.
Thank you. I've got, speaking of Australia, and I see Gary's question there as well in the chat. I'll pick that up, but let's look at Les Pickett. Les is saying, while it's important to cover the essentials in the articles, I've found that too much detail can restrict local action in ways that are not in the best interest of the company. Your thoughts, please. Les is from Australia. You picked on Australia.
I agree with the message from Australia. You mustn't write in so that the directors in Australia almost become immobile. They can't move. They are tied with their hands behind their back. I mean, what are they? They're not directors. They're not applying their minds. So you need them. So you've got to be careful in drafting and the language used in your articles of association. But that's why I say the most important thing in the group companies in promoting a product is your marketing and advertising. And you get that right. And it can't be inconsistent in one country from another, because then you start interfering with the reputation of Rosie's face cream. So that's a critical issue. Materiality becomes critical.
What happens if you do get it wrong and you do tie the board's hands behind their back? What does the board do?
Well, then you and I, I'm afraid, shouldn't be directors of the HoldCo. The shareholders should remove us, because if we plan like that, then we're not letting those Australian directors who have a knowledge of the Australian scenario, which we don't have, to really act and make sure that company promotes Rosie's face cream, but with our marketing strategy, but following the Advertising Standards Authority, for example.
So what does the board of the subsidiary in Australia do to make themselves heard, that actually the hands are tied?
Well, as I said, their hands can't be tied to the extent that they're immobile and not contributing to the running of the company in a responsible manner, because you need that application of mind to act in the best long-term interest of the health of that subsidiary. But it's the marketing and advertising that becomes critical. But to handcuff your directors so that they become puppets of, is not good governance. And
so does that the directors of the subsidiary company, do they go to the board of the holding company, or do they go to the shareholders, or how does that work?
They report to the HoldCo, which is, I'm going to assume, the sole shareholder.
Okay.
They report to HoldCo. They actually report to their company, and through their company, it goes to all their stakeholders, and the major stakeholder would be the HoldCo.
And the HoldCo, because they're the shareholder in their role as
shareholder. They have other
shareholder.
stakeholders there. They suppliers, local suppliers of the olive oil that goes into Rosie's face cream, whatever it is, the avocados, whatever.
So they complain to their shareholders, basically. They have that discussion with their shareholders. And their shareholder happens to be the holding company.
Yeah, the holding company. Yeah, the other complicating factor is, from a tax point of view, and now with fair tax, it's becoming more difficult, but a lot of group companies have taken the intellectual property and sold it to a company in a, let's say, almost tax-free zone.
Yeah.
And the companies below pay for the use of the intellectual property, making Rosie's face cream with avocados and olive oil and whatever other ingredients are used. And so they reduce the income in Australia and South Africa. And so your bottom line improves because you're paying less tax.
Yeah.
But of course, those kind of structures are being looked at through a magnifying glass these days.
And then you have that.
It just makes the group more complicated. Those structures,
And from an IT perspective, we have so many of those system agreements where the holdco buys the big system. Everybody has to use the system, and these management fees get deducted out of these countries, and the tax doesn't get paid in the countries. And where's your ethical approach to paying for the communities in the country?
Exactly.
So there's a problem there. Here's a practical one. Pumlani and Moketsi is saying, so Pumlani says, what happens in the event of a conflict between those four instruments, the articles and the MOI and articles, the contracts, the shareholders agreement, and the governance framework? And Moketsi says, and which takes precedence, because that's your legal mind, obviously. And then Moketsi says, in the case where the antiquated MOI contradicts the evolved legal regime, which one should the board apply for compliance purposes? Nice question.
Well, the board must obviously come to a conclusion what's in the long-term best interest of the health of that company and what they're going to apply. Subject to the question of whatever written into the Articles of Association. But that's why I said, you've got to write into your article of association a dispute resolution clause, because he's absolutely right. There could be a dispute arising out of the contracts and the what's written into the articles, and you must have a mechanism to resolve that dispute, because you don't want into fighting in intercompany with 30 jurisdictions. I mean, it could be a legal nightmare.
Here's one from Bredner. 5 companies, non-profits, with a common purpose and the same board members hold board meetings simultaneously. And I've seen this with groups of profits. It's one board meeting, seemingly for operational expediency. Would you consider chairing or insist on individual meetings in line with best practice? And we see that often where we've got smaller subsidiaries and financial services. The bank is generally the big gorilla, and then you've got kind of insurance and smaller entities around it. And you find that there's one board meeting, whole day, does everybody.
Well, I'm opposed to that one board meeting, because you actually, it becomes that the directors in the subsidiary lose that original intellectual thinking and application of mind in the best interest of the health of that company. They just see everything as one big thick worm, instead of they actually have to keep realizing that this is a separate legal persona. They've got to act subject to what's in the Articles of Association in the long-term best interest of the health of that company. So it's very dangerous, I think. And so I've always looked at it as an umbrella approach. You've got your whole co at the top, it's the umbrella. And then you've got all your subsidiaries, let's say in 30 different jurisdictions, different laws and things. Well, you've got to deal with that. And there might be conflicts between. So you've got to be careful how you frame your contracts between the whole co and the subsidiary, for example. But if there are disputes, you've got a mechanism to resolve them. And you've got to have that in your articles.
Lots of people are going to go back to the articles now, dust them off, find them. The one from Gary, he often works on mergers and acquisitions, representing the acquired company. These are always complex situations when the buyer insists on 2 phases of acquisition with complex terms, including profit guarantees, for example, 70% of purchase initially and the remaining 30% in 3 years' time, those kind of structured finance deals. Are there good models of governance of the 3-year JV in that example that protect the interest of the seller at the end of the JV term? Well, okay, this is interesting. So are there mechanisms to protect? And I guess you could write them in.
You could write them in. I mean, you could have a lien over the company's income, for example. You could have material bond over the plant and machinery of the company, for example. So you secure what is owed to you by the subsidiary. So that's the law of contract, and that's fine between the 2 companies. But mergers and acquisitions, I'm pleased we've got an M&A on the line, because I've been involved in several M&As, and always supposed to be equal. There is never an M&A where someone ends up as dominant. And so you can write in whatever you like, but in practice, what happens is one party becomes dominant in that M&A. And that's been my experience anyway.
Neo here says they would like for you to clarify methods and strategies that could possibly facilitate clarify methods and strategies that could be possibly facilitate in a situation where either boards or subsidiaries are from an entrepreneurial background and the knowledge is slightly hollow towards the response, achieving what is required from the mandate or the project. I'm from a project management background and would like to navigate myself in achieving chairing better in stakeholder instance of stakeholder meetings. So I guess what we're talking about here is that we've got entrepreneurial, innovative organizations that have been brought in almost like a nursery, a breeding ground of innovation, to an organization that's far more static and staid. So you've got different cultures of organizations within one group. How would you go about, in this example, how would you have group policy applying across those different types of organizations?
That happens, and things are material. I would call a meeting of the HOLCO and say, this is what's happened. And we would have to, I believe, investigate what is in the long-term best interest of the health of achieving Rosie's, because now our purpose has changed, achieving Rosie's face cream to have a global product. And if those innovative thoughts are coming through from a subsidiary, we should think about them. If necessary, amend the Articles of Association. As the holding company, I'm going to assume we've got the majority shareholding, or we've got friendly shareholders around in the subsidiary, and we just amend the Articles of Association. If they're innovative and in the long-term best interest of that company and the whole group, well, then you and I, as directors in the whole, have to apply our mind to it, and if necessary, amend the Articles of Association. That would be our duty.
Going back to that, the articles and MOI again. Tatong says, if the subsidiary is part of a joint venture and there are board meetings held for the joint venture, does the subsidiary still have to have separate board meetings, even though the majority of the business of the subsidiary is in the joint venture?
Should have separate board meetings, separate companies.
I've got so many questions, and I know we've only got 4 minutes left. One of them is the use of shared committees, board committees, and yeah, dangerous. So how does that work?
Because you have different issues and different circumstances, and you need skills for the one and different skills for another. So very dangerous to share an audit committee for 5 separate companies, the same audit committee, and have an audit committee in one day for all 5 companies. It's red bell. To me, there's red flags all over the place.
That's it, yeah. And in that instance, if there is a shared committee, would the boards of the subsidiaries then delegate their responsibilities and authority to the shared committee, and then expect reports back to that board?
Well, they can do that, but they can't abdicate their responsibility. So they can do it, but they can't abdicate their responsibility. So that if the information comes up, they have to interrogate it and see if it's in the long-term best interest of the health of that company at that time in those circumstances. And if they don't do that, they failed in their duty of care to the company. So yes, you can have one big fat worm, as I call it, rather than an umbrella situation. But I'm against those big fat worms like one. Imagine, Carrie, let's go to back to sustainability reporting, which is de novo, something new, you know. Imagine a group of 30 different companies, 30 different jurisdictions, and you have one sustainability committee meeting. I mean, it would be absolutely a waste of time almost.
Yeah, because the countries are so different.
So different, and you could have one group follow the ISSB. There might even be an Indian company which has got their own standards of sustainability reporting. So you'd run into huge problems.
And of course, what we've been talking about today isn't only for multinational groups of organizations, it's also for national groups of organizations. Okay, the compliance might be different, but the regulators the compliance might be, in the country.
It's easier if you have all your subsidiaries in South Africa, let's say, and you've got your HOLCO in South Africa. Of course, everybody's got the same legal and regulatory thing. So it's easier. You don't have to check these things carefully to a magnifying glass. So it's easier, but That doesn't mean you don't have to apply your mind in Australia and London. You have to.
Well, thank you, Prof King. It's been very insightful. We've got so much to take away and hear. Our next Taking the Helm event with Prof King is on the 14th of August. So please join the community, join our mailing list. We're going to open up registrations for that towards the end of the month. But please, we're going to be talking about dealing with, let me just get the thing again, poorly performing boards. So how to deal with poorly performing boards. And we'll bring through also the group consideration of poorly performing subsidiaries within a group. So thank you again, Prof King, for being online with us today. We certainly learned a lot. Given what everybody's saying, thank you very much for sharing your insights and your wisdom with us today. Thank you. And thank you, everyone.
One final word. Please, everyone, go back and check your articles of association.
Absolutely, your MOIs. Thank